Before we dive in, let me be crystal clear. I am not a financial advisor, and this video is for informational and educational purposes only. The world of digital currencies is incredibly volatile and carries significant risk. You should always do your own research and consult with a qualified professional before making any investment decisions. This presentation is not an offer to buy or sell any securities or digital assets. My goal here is to give you the framework to think critically about this space, not to give you financial advice. You've probably heard it all before. Crypto is a scam. It's a bubble. It's magic internet money used for illicit activities, a giant Ponzi scheme waiting to collapse. And you know what? A huge portion of the crypto world absolutely is. It's filled with hype, scams, and projects that will go to zero. If that's all you've heard, it makes perfect sense to be skeptical. I was too. But what if I told you that dismissing the entire concept is like seeing the early internet in 1995, with its slow dial-up and clunky websites, and calling the entire thing a fad for nerds? What if, buried underneath all that noise, is a technological revolution that will fundamentally reshape the concept of money, ownership, and trust for the next century? This isn't about getting rich quick. This is about understanding the future. And over the next 10 parts, we are going to pull back the curtain and give you the ultimate guide to the long-term potential of digital currencies. We're going to cut through the jargon, ignore the hype, and focus on the fundamental principles. By the end of this series, you won't just understand what a blockchain is. You'll understand why it matters to you, your savings, and the future your children will inherit. To really grasp this, we have to go back in time. Not to the invention of Bitcoin, but to the crisis that made it necessary. Picture it, 2008. The global financial system is on fire. Giants of Wall Street like Lehman Brothers, who had been around for over 150 years, vanished overnight. Banks that were considered too big to fail were, in fact, failing. People's life savings, their retirement funds, their 401ks, all were in jeopardy because of a complex web of risky bets and opaque financial instruments that almost nobody understood. The trust that held our entire economic system together was shattered. Governments and central banks, including the US Federal Reserve, responded the only way they knew how. They printed money. Trillions and trillions of dollars created out of thin air to bail out the very institutions that caused the problem. It was a necessary evil, they said, to prevent a total collapse. But it exposed a fundamental flaw in our system. A small, unelected group of people can make decisions that devalue the money in your pocket, and you have no say in the matter. It was in the smoking wreckage of that crisis, on October 31, 2008, that an anonymous person or group named Satoshi Nakamoto quietly published a 9-page white paper online. The title was Bitcoin, a peer-to-peer electronic cash system. It wasn't a get-rich-quick scheme. It was a direct answer to the failures of 2008. It proposed a new kind of money that wasn't controlled by any central bank, money that couldn't be printed into oblivion to bail out failing corporations, money that was secured by mathematics and cryptography, not by the promises of politicians or bankers. For the first time, we had a potential alternative to the traditional financial system, a system where you, the individual, could truly be your own bank. Now you might be thinking, that's a nice story, but what does it have to do with me today? The system works fine. I can swipe my credit card, I can use Venmo, I get my paycheck. And you're right. On the surface, for most people in the United States, the system seems to work. But look closer. What is the real value of the dollar in your wallet? Since 1971, when the US dollar was officially untied from gold, it has lost over 90% of its purchasing power. That coffee that cost a quarter when your parents were young now costs $3 or $4. That's not the coffee getting more expensive. That's your money getting weaker. This slow, silent erosion of your savings is called inflation, and it's a direct result of the continuous creation of more money. Digital currencies at their core are an attempt to solve this problem. Bitcoin, for example, has a hard-coded limit of 21 million coins. There will never be more. No board of directors, no government committee can decide to create more to pay for a war or bail out an industry. It's a system of predictable scarcity in a world of infinite printing. This is the single most important concept to understand. It's a shift from a monetary system based on authority to a system based on verifiable mathematical truth. But this goes so much deeper than just a new form of money. The technology that powers Bitcoin, called the blockchain, is the real revolution. Think of it like this: the internet was a revolution for information. Before the internet, information was centralized. You got it from a few major newspapers, TV networks, or encyclopedias. The internet decentralized information, allowing anyone, anywhere, to share and access knowledge instantly. The blockchain is a revolution for value. Right now, our value, our money, our stocks, the deed to our house is all centralized. It sits in databases owned by banks, brokerages, and governments. To send money, you have to ask a bank to update their ledger. To sell a stock, you have to go through a broker. You are always relying on a trusted middleman. The blockchain creates a way to have a shared, secure, and transparent ledger that isn't owned by any single entity. It allows us to transfer value directly from person to person, anywhere in the world, without needing a bank or a credit card company in the middle. This isn't just a theory. It's already changing industries. We're talking about a world where an artist can sell their digital art directly to a fan and automatically receive a royalty every time it's resold forever. A world where you can take out a loan or earn interest on your savings without ever stepping foot in a bank, through a system run entirely by code. A world where international payments that currently take days and cost a fortune can happen in seconds for pennies. This technology enables verifiable digital ownership, something that was never possible before. You can own a piece of a digital world, a unique character in a game, or a digital identity that you, and only you, control. The media loves to focus on the crazy price swings, the overnight millionaires, and the spectacular collapses. And that's the easy story to tell. It's dramatic. But it's like judging the potential of the entire internet based on the pets.com bubble bursting in the year 2000. They're missing the point. The real story isn't the price of one Bitcoin today. The real story is the steady, relentless building of a new parallel financial system, one that is more open, more transparent, and more accessible to everyone on the planet. Over the course of this series, we will dissect this piece by piece. We'll explore the different types of digital currencies, from Bitcoin as a store of value to Ethereum as a platform for decentralized applications. We'll look at the rise of stablecoins, which are pegged to the US dollar, and how they're revolutionizing payments. We'll tackle the tough questions. What about the environmental impact? What are the real risks of government regulation? And how do you even begin to separate the legitimate, world-changing projects from the thousands of worthless scams? This is your masterclass. We're not just looking at the what, we're focusing on the why and the how. So the real question isn't, will crypto make me rich by next Tuesday? The real, far more important question is, how is this technology about to reshape the next 100 years of finance, commerce, and the internet itself? And how do I position myself to understand and navigate that change? To answer that, we first have to understand the single biggest weakness of the money you use every single day. That weakness is deceptively simple. It's the fact that your money is designed to lose value over time. It's a feature, not a bug. Every dollar in your bank account, every bill in your wallet, is like an ice cube sitting on the counter. Slowly, silently, it's melting away. We call this inflation, a word we hear all the time, but most of us don't truly feel its corrosive power until we look back over decades. Think about it this way. In 1971, you could buy a brand new Ford Pinto for $2,000. Today, $2,000 might get you a down payment on the sales tax for a new Ford. In the 1960s, a silver quarter was made of 90% actual silver. You could take 4 of them, $1 worth, and buy a gallon of gas with change left over. Today, that same amount of silver, melted down from those 4 quarters, is worth about $20. But the 4 quarters themselves, they're still worth just $1. The value wasn't in the number stamped on the coin. It was in the metal itself. The currency was a representation of something real and scarce. What changed? The simple answer is that we untethered our money from anything real. In 1971, the United States officially severed the dollar's last link to gold. From that moment on, the US dollar became what's known as a fiat currency. The word fiat is Latin for let it be done. It is money that has value simply because a government decrees that it does. It's not backed by a physical commodity. It's backed only by the trust and faith we have in the government that issues it. And this gives that government a remarkable power. The power to create more of it, out of thin air. Imagine you and your neighbors all agree to use special blue rocks as money. There are only 1,000 blue rocks in the entire town, so they're quite valuable. You work hard and save up 100 of these rocks. You own 10% of the town's entire money supply. You feel secure. But one night, the mayor, who controls the blue rock quarry, secretly mines 10,000 new blue rocks and starts spending them. Suddenly, there are 11,000 blue rocks in circulation. Your 100 rocks are no longer 10% of the supply. They're now less than 1%. You didn't lose any of your rocks, but their purchasing power, what they can actually buy, has been massively diluted. You've been robbed, but in a way that's almost invisible. This is the secret of inflation. It's a stealth tax that you never vote on, but you pay every single day. For decades, this process was relatively slow and steady. The money printer, as it's often called, was running at a low hum. But in the 21st century, and especially after the financial crisis of 2008, that low hum became a deafening roar. To prevent the entire financial system from collapsing, central banks around the world, led by the US Federal Reserve, began creating unprecedented amounts of new money. They called it quantitative easing, a friendly academic-sounding term for a process of digital money creation on a scale never before seen in human history. They bought up bonds and other assets from banks, flooding the financial system with trillions of newly created digital dollars. The goal was to encourage lending and stimulate the economy, but it had a profound side effect. It dramatically increased the total supply of money. From 2008 to 2014, the base money supply in the United States more than quadrupled. Then, in response to the global crisis of 2020, that process went into hyperdrive. In a single year, the US created more money than it had in its first 200 years of existence. Think about that. More than 20% of all US dollars ever created were printed in the year 2020 alone. This isn't a conspiracy theory. It's public data available directly from the Federal Reserve. Now, why does this matter to you? Because every time new money is created, the value of the money you've already saved goes down. Your salary might go up, but if prices for gas, groceries, and housing are going up even faster, you are getting poorer. Your savings account is that bucket of water, but the hole in the bottom is getting bigger. You're trying to save for retirement, for a house, for your children's future, but you're fighting against a constant, invisible headwind. You are running up a down escalator. For generations, the answer to this problem was to invest. Don't just save your money. Put it into assets that can outpace inflation. Stocks, real estate, fine art. The idea is to trade your melting ice cubes for something solid. But this creates another problem. It forces everyone from grandmothers to college students to become a speculator in the stock market just to preserve their wealth. You're forced to take on risk simply to stand still. What if you just want to save? What if you want to store the economic energy you've earned through your hard work in something that will hold its value over 10, 20, or 50 years? This is the fundamental problem that digital currencies were created to solve. The inventor of Bitcoin, the mysterious Satoshi Nakamoto, embedded a message in the very first block of transactions ever created. It was a headline from a British newspaper dated January 3, 2009. The Times 03/Jan/2009 Chancellor on brink of second bailout for banks. It was a timestamp and a mission statement. This was a direct response to a financial system that seemed broken, a system where the rules could be changed at any time by a small group of people, creating trillions of dollars to bail out the institutions that caused the crisis, while the value of ordinary people's savings was diluted in the process. So what was the solution? It was an idea that was both radical and profoundly simple. What if we could create a new form of money? A form of money with rules that could not be changed. What if, like gold, it was fundamentally scarce, but unlike gold, it could be sent anywhere in the world in an instant with nothing more than an internet connection? The core breakthrough was something called digital scarcity. Before 2009, this concept was an oxymoron. The very nature of digital information is that it can be copied perfectly, infinitely, and for free. You can copy an MP3 file, a Word document, or a digital photo a million times, and each copy is identical to the original. This is fantastic for information but terrible for money. If you could just copy and paste a digital dollar, it would be worthless. This is known as the double spend problem, and for decades, the only way to solve it was to have a trusted central party, like a bank or a credit card company, keep a central ledger of who owns what. They are the bouncers at the door, making sure nobody spends the same digital dollar twice. Bitcoin proposed a different way. It created a system where, for the first time in history, a digital item could be provably unique and scarce, without needing a central authority to verify it. It's the difference between a perfect digital copy of the Mona Lisa, which is worthless, and the actual Mona Lisa hanging in the Louvre. One is infinitely reproducible information, the other is a provably scarce asset. Bitcoin managed to create a digital Mona Lisa. How? By creating a shared public ledger that was secured not by a company or a government, but by a global network of computers, all working together to validate every single transaction. This ledger established a set of rules that were locked in from the very beginning. The most important of these rules was about supply. There will only ever be 21 million Bitcoin. Ever. It's written into the core code. No one can change it. No CEO can decide to issue more to pay for a new corporate jet. No central banker can fire up the printers to fund a bailout. No politician can vote to increase the supply to pay for a new program. The supply is fixed, predictable, and transparent to everyone. It's the ultimate answer to the secret quarry of the blue rocks. In this new system, everyone can see the quarry. Everyone knows exactly how many rocks exist, and how many will ever exist. Your 100 rocks will always be the same percentage of the total supply. This idea of provable digital scarcity is the single most important concept to understand. It is the bedrock upon which this entire new financial world is being built. It's a fundamental shift in how we think about value in a digital age. But it also raises an immediate and critical question. If there is no bank, no Federal Reserve, no government in charge, then who is? Who enforces the rules? How can we possibly trust a system with no leader, no headquarters, and no one to call if something goes wrong? How does a leaderless global network of computers actually agree on anything, let alone the secure transfer of trillions of dollars in value? The answer lies in one of the most brilliant solutions to a problem that has stumped computer scientists and philosophers for decades. It's a problem called the Byzantine generals problem. Imagine a group of generals surrounding an enemy city. They need to coordinate their attack, but they can only communicate through messengers. The catch? Some of the generals might be traitors. If they all attack at once, they win. If they attack at different times, they lose. How can the loyal generals agree on a plan of attack when they can't trust each other, and can't be sure if the messages they receive are genuine? For years, this was just a fascinating thought experiment. But in the digital world, it's a very real problem. How can a network of computers, any one of which could be malicious, agree on what is true? How can they agree that you sent me 1 Bitcoin and not a million or none at all? This is the puzzle Satoshi Nakamoto solved. And the solution is an invention so elegant, so powerful, that it's now being applied to thousands of different industries. It's called the blockchain. At its heart, a blockchain is just a special kind of database, a ledger. Think of it like a public notebook that everyone in the world can see. Every time a transaction happens, say, Alice sends Bob 1 Bitcoin, it's recorded in this notebook. But it's not just any notebook. This one has superpowers. First, it's distributed. Instead of one person holding the notebook, thousands of people all over the world have an identical copy. So if your copy gets destroyed or someone tries to tamper with it, it doesn't matter. There are thousands of other copies to verify the truth. Second, the pages of this notebook, which we call blocks, are chained together using cryptography. Imagine every page ends with a unique, super complex digital fingerprint, called a hash. This fingerprint is created based on everything written on that page. If you change even a single comma in a transaction, the fingerprint changes completely. Now, here's the genius part. The fingerprint of the previous page is included on the top of the current page. So, page 2 contains the fingerprint of page 1. Page 3 contains the fingerprint of page 2, and so on, creating a chain of blocks. This creates an unbreakable digital seal. If a hacker wanted to go back and change a transaction on, say, page 10, they would alter its contents, which would change its unique fingerprint. But because that original fingerprint is recorded on page 11 would now be invalid. The chain would be broken. So the hacker would have to fix page 11, which would change its fingerprint, which is recorded on page 12, and so on. They would have to rewrite the entire rest of the notebook from that point forward instantly. This cryptographic linking makes the ledger effectively immutable. Once a transaction is recorded, it's set in stone for everyone to see forever. Okay, so we have a tamper-proof public notebook. But that still leaves the biggest question unanswered. In a network with no boss, who gets to write on the next page? Who decides which transactions are valid and gets to add the next block to the chain? If anyone could do it, a scammer could just write "Everyone send me all their money" and add it to the chain. This is where Satoshi's true stroke of genius comes into play. He created a competition. He said, in order to earn the right to add the next block, you have to prove you've done a huge amount of computational work. This process is famously known as mining. But miners aren't digging for anything in the ground. They are competing to solve an incredibly difficult mathematical puzzle. It's like a global lottery, but instead of buying a ticket, you use a super powerful computer to guess a specific number. The puzzle is designed to be so hard that with all the computers on the entire Bitcoin network combined, It takes, on average, 10 minutes to find the solution. Think about it. Thousands of specialized computers all over the world burning massive amounts of energy, all guessing trillions of random numbers per second, just trying to be the first one to find that one magic number that solves the current puzzle. It's a brute force race of pure computational power. Now, why would anyone do this? Why would people spend millions of dollars on specialized computers and electricity bills to guess numbers? Because of the reward. The first miner to solve the puzzle gets two things. First, they get to gather up all the most recent transactions, put them into the new block, and add it to the chain, collecting the small transaction fees attached. But more importantly, they are rewarded with a brand new, freshly created amount of Bitcoin. In the beginning, this was 50 Bitcoin per block. Today, it's 6.25. This reward is how new Bitcoin is created and enters circulation. It's the economic incentive that fuels the entire system. This process, called proof of work, is what solves the Byzantine general's problem. It's how the leaderless network comes to an agreement. The longest chain, the one with the most computational work poured into it, is considered the one true version of the ledger. To cheat the system, a bad actor would need to control more than half of the entire network's computing power. This is known as a 51% attack. They would have to go back, change a block, and then single-handedly resolve the puzzles for that block and every single block after it, faster than the entire rest of the world's miners combined. The cost to acquire that much hardware and electricity would be astronomical, billions and billions of dollars. And here's the beautiful part of the game theory. If you had that much power, it would be far more profitable for you to just use it to mine honestly and collect the block rewards than it would be to attack the network. Attacking the network would destroy public confidence in the currency, crashing its price and making your stolen coins, and your billions of dollars in mining equipment, virtually worthless. The system brilliantly incentivizes honesty. It makes cooperation more profitable than cheating. So let's put it all together. We have a transparent public ledger that everyone can see. We have a cryptographically sealed chain that's nearly impossible to tamper with. And we have a global, decentralized competition where miners are paid to verify transactions and secure the network. No single person or company is in charge. The trust isn't placed in a bank or a government. The trust is placed in the code, in the mathematics, and in the economic incentives that bind everyone together. It's a self-auditing, self-policing system where thousands of competitors, all acting in their own self-interest, collectively create one of the most secure computer networks ever conceived. This is the fundamental breakthrough of Bitcoin. It wasn't just digital cash. It was the first working example of a system that could create digital scarcity and achieve decentralized consensus. It proved that we can trust a system with no leader, because the network itself, governed by unchangeable rules and economic incentives, becomes the leader. But this revolutionary system is not without its critics, or its monumental challenges. This proof-of-work mechanism, while brilliant, is incredibly slow. A network that can only process a handful of transactions per second can't possibly serve as the backbone for global finance. And the elephant in the room? That global lottery of computers guessing numbers? It consumes an astonishing amount of energy, more than some entire countries. How can a technology of the future be built on a foundation that seems so inefficient and environmentally costly? Is this fatal flaw the Achilles heel of digital currencies? Or is there another way? That question, the energy question, is not just a footnote. For many, it's the headline, the deal breaker. The image of massive warehouses filled with humming computers, burning through the power grid just to mint a single digital coin, feels fundamentally broken. Seems wasteful, almost primitive. And if you look at the raw numbers for Bitcoin, it's hard to argue. The network's electricity consumption has been compared to that of Argentina, of the Netherlands, of the United Arab Emirates. It generates an amount of electronic waste equivalent to a small country every single year. So, is this the end of the story? A brilliant idea crippled by a catastrophic, planet-killing appetite for power? The reality is far more complex. To understand why this energy is being used, you have to understand what it's buying. And what it's buying is security. Pure, unadulterated, brutally effective security. This system, known as proof of work, was a stroke of genius by Satoshi Nakamoto. He needed a way to make sure that everyone in a decentralized network could agree on the state of the ledger without trusting each other. His solution was to make it incredibly difficult and expensive to add new transactions to the chain. He turned record-keeping into a competition. Think of it like a global perpetual lottery. Computers all over the world called miners are constantly guessing a random number. The first one to guess the correct number gets the right to bundle up the latest batch of transactions into a block, add it to the blockchain, and in return, they are rewarded with newly created cryptocurrency. The key is that guessing this number requires immense computational power. It's not a test of intelligence. It's a test of raw, brute force calculation. And that calculation requires electricity. Lots of it. This energy expenditure is not a byproduct. It's the entire point. It's a digital representation of work. You are proving you did the work by showing your massive electricity bill. This is what gives the network its integrity. To cheat the system, to try and spend the same money twice, you would need to control more than half of the entire network's computing power. You would have to outwork everyone else combined. Imagine trying to rewrite the history of Bitcoin. You'd have to go back to a block in the past, change it, and then redo all the work, remine every single block that came after it, faster than the entire rest of the world is building the real chain. The cost in hardware and electricity to do that would be astronomical, easily running into the billions of dollars. And even if you succeeded, you would have undermined the very network you just spent billions to control, making its currency worthless. The energy consumption is a feature, not a bug. It's a massive energy-based wall that makes the cost of attacking the network prohibitively expensive. It's what anchors this digital system to the physical world, tying it to the real-world cost of energy. Furthermore, the narrative that this energy is all dirty is an oversimplification. Miners are economically rational. They are relentlessly searching for the cheapest electricity on the planet. And what is often the cheapest electricity? It's stranded energy. It's the excess power from a hydroelectric dam in a remote region with no city to sell it to. It's the natural gas being flared off at an oil field because it's not economical to transport. Miners can set up shop anywhere, turning what was once wasted energy into economic value and digital security. A growing percentage of the mining industry is actively powered by renewable sources, precisely because it's the most cost-effective option. And let's be honest, we rarely apply this same level of scrutiny to our existing financial system. What is the carbon footprint of the entire global banking apparatus? The data centers, the thousands of high-rise office buildings, the ATMs, the armored trucks, the printing and minting of physical cash, the employee commutes, the corporate jets. When you add it all up, the legacy system is an energy behemoth in its own right. It's just so diffuse and integrated into our lives that we never think to calculate its total cost. This doesn't excuse crypto's energy use, but it does provide critical context. But even with that context, the core problem remains. Can a system that requires a country's worth of power ever scale to serve the entire globe? Is there a better way? This is where the story takes a fascinating turn, because the answer is a resounding yes. The industry has been wrestling with this problem for years, and the solution that has emerged is as elegant as proof of work is forceful. It's called proof of stake. If proof of work is about who can work the hardest, proof of stake is about who has the most skin in the game. Instead of miners competing with raw computing power, you have validators. These validators lock up, or stake, a certain amount of their own cryptocurrency as collateral. Think of it like a security deposit. By staking their own funds, they are making a financial commitment to the health and integrity of the network. The network then uses an algorithm to quasi-randomly select one of these validators to create the next block. The more you stake, the higher your chances of being selected, and thus the more you earn in rewards. But here's the crucial part. If you act maliciously, if you try to approve a fraudulent transaction, the network can automatically destroy, or slash, a portion or even all of your staked collateral. The security model shifts from a physical one, based on the cost of energy, to an economic one, based on direct financial incentives and penalties. The deterrent is no longer the threat of a massive electricity bill. It's the threat of losing your own capital. The impact of this shift is staggering. Because you're no longer running a brute force guessing game, the computational requirements plummet. You don't need warehouses of specialized, power-hungry machines. A validator can be run on a modest computer. The energy savings are not incremental. They are a quantum leap. We're talking about a reduction in energy consumption of over 99.9%. It's the difference between a system that consumes the energy of a nation and one that consumes the energy of a small town. This isn't just a theoretical idea. It's already happened. For years, the second largest cryptocurrency, Ethereum, ran on proof of work just like Bitcoin. It faced the same criticisms about its environmental impact, but its developers were planning something audacious, an event they called the merge. It was one of the most complex and ambitious software upgrades in history. They planned to switch the entire live multi-hundred-billion-dollar network from proof-of-work to proof-of-stake, all while it was still running. It was like trying to swap out the engine of a 747 mid-flight with millions of passengers on board. Many thought it was impossible, that something would go catastrophically wrong. But in September of 2022, they did it. The merge was successful. And overnight, Ethereum's energy consumption, its carbon footprint, vanished. It was reduced by a factor of nearly 2,000. It was a monumental achievement, proving that a major digital currency could secure itself and process transactions without costing the planet. So now, the world of digital currencies is split between two philosophies. On one side, you have Bitcoin, the original, clinging to proof-of-work as the only truly battle-tested, thermodynamically secure method for creating a decentralized hard money. Its supporters argue that the enormous energy cost is a necessary price for ultimate security and censorship resistance. On the other side, you have Ethereum and a new generation of currencies built on proof-of-stake, arguing that they have found a more sustainable, efficient, and scalable path forward. They contend that economic incentives are just as powerful as physical work, without the environmental baggage. This schism represents a fundamental fork in the road for the future of this technology. But solving the energy crisis, as critical as it is, only addresses one major hurdle. Switching to a more efficient engine is a massive step, but it's useless if the car is still stuck in first gear, inching along in a traffic jam. Can these digital currencies, whether proof-of-work or proof-of-stake, ever actually be fast enough to handle the demands of a global economy? Can they compete with the instantaneous transactions of Visa or MasterCard, which handle tens of thousands of transactions per second? Or are they all fundamentally doomed to be the slow, clunky dial-up internet of finance? That question is the billion-dollar, or perhaps trillion-dollar elephant in the room. And the honest answer, for the first generation of cryptocurrencies like Bitcoin, is a resounding no. Not on their own. The way Bitcoin was originally built, it is fundamentally the dial-up internet of finance. It processes about 7 transactions per second. 7. Visa, on a slow day, handles over 24,000. It's not even a competition. It's like comparing a horse-drawn carriage to a fighter jet. But here's the critical thing to understand. This wasn't an accident. It was a choice, a deliberate, calculated trade-off. In the world of blockchain engineering, there's a famous concept known as the blockchain trilemma. Picture a triangle. At the 3 corners you have security, decentralization, and scalability. The trilemma states that any blockchain can only truly optimize for 2 of these 3 corners. You can have a system that's incredibly secure and decentralized, but it will be slow. That's Bitcoin. You can have one that's fast and secure, but you'll have to sacrifice decentralization, meaning it's controlled by a small group of entities, which starts to look a lot like the traditional banking system we already have. Or you can have one that's fast and decentralized, but it would likely be so complex that it would be riddled with security holes. Satoshi Nakamoto, the creator of Bitcoin, chose security and decentralization above all else. Why? Because the entire point was to create a form of money that no single government, company, or person could control or shut down. To achieve that, the network had to be simple enough for thousands of people all over the world to run it on regular computers. It had to be so robust that no one could cheat the system. The price for that unprecedented level of security and decentralization was speed. Think of the Bitcoin network like a global shipping company that has only one very small, very slow truck. This truck, called a block, has a fixed size. It can only hold about 1 megabyte of data, which translates to a few thousand transactions. And to make matters worse, this truck only leaves the warehouse every 10 minutes. That 10-minute delay is a crucial security feature, ensuring that all the company's branches around the world have time to agree on which packages are on the truck before it leaves. But the consequence is a massive bottleneck. When more people want to send packages than the truck can hold, a bidding war starts. People start offering higher and higher shipping fees, or transaction fees, to make sure their package gets on the next truck. In 2021, during the peak of the bull market, the average fee to send a single Bitcoin transaction spiked to over $60. $60! You can't buy a $5 cup of coffee if the fee to swipe your card is 12 times the price of the coffee itself. This is the scalability problem in a nutshell. It's what keeps cryptocurrencies from being a viable, everyday medium of exchange. Ethereum faced the same demon. It was designed to be faster than Bitcoin, with a new truck leaving every 12 seconds instead of 10 minutes. But Ethereum's truck wasn't just carrying simple payment information. It was carrying complex computer programs, powering the worlds of DeFi and NFTs. The demand was astronomical. The network became so clogged that it was like trying to merge onto a Los Angeles freeway at 5 p.m. on a Friday, but the entire freeway was only one lane wide. Gas fees, the equivalent of Bitcoin's transaction fees, skyrocketed into the hundreds, sometimes thousands of dollars for a single operation. The dream of a decentralized world computer became a playground for the wealthy, pricing out the average user completely. For years, this was the great, seemingly unsolvable crisis. Critics laughed. They said, "See? This whole thing is a toy. It will never work at a global scale." And for a while it looked like they might be right. But then something shifted. The brightest minds in the space realized they were trying to solve the wrong problem. They were trying to make the main highway wider, when what they really needed was a system of local roads and express lanes built on top of it. This is the birth of what are called Layer 2 solutions. The idea is elegantly simple. Instead of trying to cram every single transaction, every coffee purchase, every digital art sale, every micropayment onto the main super secure but slow blockchain, you handle them off to the side on a separate, faster layer. This second layer processes thousands of transactions cheaply and instantly, and then it bundles them all up and settles the final balance in a single neat transaction back on the main layer. Think of it like this. The main blockchain, Layer 1, is like the Federal Reserve. It's the ultimate source of truth, incredibly secure, but you don't interact with it to buy groceries. Instead, you use systems built on top of it like Visa or your local bank, which are faster and more convenient for everyday transactions. Layer 2s are crypto's version of this. The most famous example for Bitcoin is the Lightning Network. It's a stroke of genius. Imagine you and your favorite coffee shop decide to open up a private payment channel. It's like starting a bar tab. You put $5 on the tab, that's one small transaction recorded on the main Bitcoin blockchain. Then, for the rest of the week, you buy a coffee every single day. Each purchase is just an update to the tab between you and the shop. These updates are instant and cost virtually nothing because they're happening privately between the two of you. They never touch the main, congested blockchain. Then, at the end of the week, you close the tab. The final balance, let's say you spent $3 and have $2 left, is then recorded as a single final transaction back on the main Bitcoin blockchain. You've just conducted 5 separate economic transactions, but only 2 tiny ones ever touched the slow, expensive main network. Now, expand that concept. The Lightning Network creates a web of these interconnected tabs between millions of users and merchants. You don't even need a direct tab with the coffee shop. As long as you have a tab with someone who has a tab with someone who has a tab with the coffee shop, the network can instantly route your payment through those connections. It turns Bitcoin from a slow, lumbering beast into a system capable of handling millions of transactions per second for fractions of a penny. This isn't a theoretical dream. It's live right now. It is the technology that allows people in countries like El Salvador to buy groceries with Bitcoin. It's what powers tipping features on social media platforms. It is the first real answer to the Visa and MasterCard challenge. Ethereum, not to be outdone, has its own thriving ecosystem of Layer 2s, primarily using a technology called rollups. The name is perfectly descriptive. A rollup company like Arbitrum or Optimism sets up shop on a powerful server. It takes in tens of thousands of user transactions, people trading tokens, buying NFTs, interacting with financial protocols, and it processes them all at lightning speed on its own system. Then it rolls them up into a single highly compressed bundle of data and posts that one tiny piece of data to the main Ethereum blockchain. It's the ultimate carpool lane. Instead of 10,000 cars trying to cram onto the highway, paying 10,000 separate tolls, one super efficient bus carries all 10,000 passengers and pays a single toll. The result? The user experience is almost identical, but the fees drop from $100 per transaction to just a few cents. This innovation has caused an explosion of activity, moving the bulk of Ethereum's daily traffic off the mainnet and onto these cheaper, faster Layer 2 networks. This is the frontier. The battle for scalability is being fought and, in many ways, won. The clunky, dial-up phase is giving way to a broadband era. The solutions are here, and they are transforming these digital commodities into something that could actually function as a global, high-speed financial network. The question is no longer just if these systems can be made fast enough for the whole world to use. The more pressing question is, even if they can, do we want them to? If we solve the technological hurdles of speed and cost, we are left facing an even more formidable beast, the very nature of the asset itself. What happens when your ultra-fast, super-cheap digital cash can lose 20% of its value while you're waiting for your pizza to be delivered? The challenge of scale may be fading, but the challenge of volatility is just beginning. This question of value is the ghost in the machine for the entire digital currency space. Because if the primary purpose of a currency is to be a stable store of value and a reliable medium of exchange, then extreme volatility isn't a feature, it's a bug. A catastrophic, system-breaking bug. So why does it happen? Why can a tweet from a billionaire, or a vague rumor from a regulator, send the entire market into a freefall or a stratospheric climb? The answer lies in the very nature of what these assets are today, versus what they hope to be tomorrow. Right now, for the vast majority of people, digital currencies aren't primarily currencies. They are speculative assets. People buy Bitcoin not to purchase coffee, but because they believe someone else will buy it from them for a higher price in the future. It's a global 24/7, high-stakes game of digital hot potato. This speculative fever creates a feedback loop. When prices go up, media attention surges, drawing in a new wave of buyers gripped by the fear of missing out, which pushes prices even higher. And when they fall, fear takes over, triggering panic selling, which pushes prices lower faster. There's no central bank to step in and stabilize things, no government to backstop the value. It's the raw, unfiltered psychology of the market, playing out in real time. Compounding this is the whale problem. In the traditional stock market like the S&P 500, the market is so vast, so deep, that it takes an immense amount of capital to make even a small ripple. It's an ocean. The crypto market, even at its peak, is more like a lake. A very large lake, but a lake nonetheless. This means that a few large holders, nicknamed whales, can create massive waves with a single large buy or sell order. Their movements are tracked, analyzed, and often mimicked, creating a market that can be steered by the whims of a few anonymous, ultra-wealthy players. So the dream of a decentralized global cash system seems to hit a brick wall. You can't build a global economy on financial quicksand. You can't price a contract, take out a loan, or save for retirement in a currency that behaves more like a lottery ticket. The architects of this new financial world knew this. They understood that to truly replace traditional money, you had to solve the volatility puzzle. And their answer was one of the most important and controversial innovations in the entire space: the stablecoin. The idea is brilliantly simple. What if you could create a digital token that has all the benefits of a cryptocurrency? It's global, programmable, and lives on a blockchain but without the wild price swings. A token that is always and reliably worth $1. This is the holy grail. A stablecoin is a digital dollar. It's the bridge between the chaotic, innovative world of crypto and the stable, predictable world of traditional finance. With a stablecoin, you can buy that pizza. You can receive your salary, pay your rent, and send money across borders without worrying that its value will evaporate overnight. It's the missing piece. But how do you create a digital token and force it to be worth $1? How do you peg a free-floating asset to a real-world one? Well, the first and most common approach is the most straightforward. You back it with real money. For every $1 digital dollar a company like Circle issues as USDC, they claim to hold one real US dollar, or an equivalent short-term asset, in a fully audited, regulated bank account. It's a digital IOU. You can, at any time, redeem your digital USDC for a physical dollar. This creates trust. The value isn't based on speculation. It's based on a one-to-one reserve of cold, hard cash. This model has become the bedrock of the crypto economy, a multi-hundred-billion-dollar industry in its own right, providing a safe harbor for traders during market storms. But for some crypto purists, this solution felt like a betrayal. The whole point was to get away from banks and trusted third parties. If your decentralized money is ultimately backed and controlled by a centralized company and its traditional bank, have you really changed anything? This ideological split led to a second type of stablecoin, the crypto-collateralized stablecoin. The most famous example is DAI. The concept is a bit more complex, but think of it like a decentralized, automated pawn shop. To get $100 worth of the DAI stablecoin, you have to lock up, say, $150 worth of a more volatile asset like Ethereum into a smart contract. That extra $50 is your collateral, your buffer. If the price of Ethereum starts to fall, the system automatically sells your collateral to ensure the DAI you created remains backed by sufficient value. It's a system held in balance not by a bank, but by code and over-collateralization. It's messy, it's complicated, but it's truly decentralized. But human ambition rarely stops at complicated. It pushes towards magic. And that led to the third and most infamous type of stablecoin, the algorithmic stablecoin. This was the dream of a truly independent currency. A stablecoin with no backing at all, Not by dollars in a bank, not by a vault of crypto collateral. Instead, it would hold its value through a clever algorithm. Imagine two tokens. One is the stablecoin, let's call it Terra USD, which is supposed to be worth $1. The other is a volatile partner coin, let's call it Luna. The algorithm linked them. If the price of Terra USD fell to 99 cents, the algorithm would allow traders to buy that cheap token and exchange it for exactly $1 worth of the partner coin Luna, pocketing a penny of risk-free profit. That buying pressure would push the price of Terra USD back up to $1. Conversely, if it rose to $1.01, the system would work in reverse. It was a beautiful, elegant piece of financial engineering, a perpetual motion machine for money, and for a time it worked. Terra USD became the third largest stablecoin in the world, the foundation of a $100 billion ecosystem. And then in May of 2022, the magic failed. A few massive, coordinated withdrawals tested the peg. The price of Terra USD slipped. As it slipped, the algorithm did its job, printing billions upon billions of the partner coin Luna to try and prop up the price. But the selling pressure was too intense. The supply of Luna went from 350 million to 6.5 trillion in a matter of days. This hyperinflation destroyed its value, which in turn destroyed the market's confidence that it could ever restore the peg. The system entered a death spiral. In less than a week, $40 billion of investor value was wiped out. Gone. It was a catastrophic failure, a digital bank run that exposed the immense fragility of trying to create value out of thin air. The collapse of Terra was a brutal lesson. Proof that stability is hard, and that trust, once broken, is nearly impossible to repair. Yet, despite the carnage, the stablecoin model itself survived. The fiat-backed coins, the USDC and the Tethers of the world, held their ground. They proved that while the market craved a decentralized solution, it valued a reliable one even more. And so, the crypto world had seemingly found its solution to volatility. It had built its bridge to the real world, a stable foundation on which a new financial system could be built. But in solving one problem, they had created a new, and perhaps even greater, one. By anchoring their new world to the old one, by creating digital dollars controlled by centralized companies, they had painted a giant, unmissable bullseye on their entire industry. They had caught the attention of the very entities they once sought to make obsolete, governments and central banks. The battle was no longer about technology. It was about to become a battle for control. The first shots in this new war weren't fired with bullets but with regulations. Not with armies but with acronyms: the SEC, the Treasury, the PBOC. To understand the fury that was about to be unleashed, you have to step inside the mind of a nation-state. For centuries, the ultimate power of any government has rested on two pillars: the monopoly on violence and the monopoly on money creation. Crypto, with its decentralized, borderless, and censorship-resistant nature, wasn't just chipping away at that second pillar. It was threatening to detonate a charge at its very foundation. This was not an economic issue, it was an existential one. And the first government to treat it as such was China. In 2021, the world watched as the Chinese Communist Party brought down an iron fist. They didn't just regulate crypto, they declared war on it. They banned financial institutions from providing crypto services. Then they went further, outlawing all domestic crypto transactions. But the kill shot was aimed at the miners. At the time, China was the undisputed king of Bitcoin mining, controlling over half of the global hash rate. It was a massive, thriving industry, and overnight it was declared illegal. The government cited concerns about financial risk and energy consumption, and while those were factors, the real reason ran much deeper. China was playing a different game. They saw the power of a digital ledger, but they wanted it on their terms. Even as they were evicting Bitcoin miners, they were deep in development of their own state-controlled alternative, the digital yuan or ECNY. This was the world's first major central bank digital currency, or CBDC. It was the government's countermove, a Trojan horse. It offered the convenience of digital payments, but with an unprecedented level of surveillance and control. Every transaction recorded, every user identified, every penny traceable back to its source. It was the antithesis of everything Bitcoin stood for. China wasn't trying to kill the technology, it was trying to domesticate it, to turn a tool of liberation into a tool of absolute control. The great mining migration that followed was a seismic event, a forced exodus of an entire industry, proving that code was not, in fact, law when a superpower decided to unplug the servers. While China chose the path of brute force, the United States chose a different, and arguably more insidious, weapon: ambiguity. In America, there was no single sweeping ban. Instead, the industry was thrown into a regulatory fog, a legal labyrinth with no map and shifting walls. Was crypto a currency to be regulated by the Treasury? Was it a commodity like gold or oil under the purview of the CFTC? Or, and this was the billion-dollar question, was it a security like a stock to be governed by the iron-willed Securities and Exchange Commission, the SEC? The government's refusal to provide a clear answer was not a sign of incompetence. It was a strategy. It was regulation by enforcement. Instead of writing clear rules for everyone to follow, agencies like the SEC would simply sue companies they believed had crossed a line that nobody knew existed until the lawsuit was filed. This created a chilling effect across the entire American crypto landscape. Founders were terrified to innovate, investors were spooked, and progress stalled, bogged down by crippling legal fees and the constant threat of a surprise attack from a federal agency. The poster child for this strategy became the SEC's landmark case against Ripple Labs. In late 2020, the SEC sued Ripple, alleging that its digital token XRP was an unregistered security and that the company had been illegally selling it to the public for years. The case became a brutal multi-year slog, costing both sides hundreds of millions of dollars. It wasn't just a lawsuit, it was a proxy war for the entire industry. The outcome would set a precedent that could either legitimize countless other projects or wipe them out of existence. The message from Washington was clear: we may not have built a cage for you yet, but we have a leash and we will not hesitate to use it. For an industry born from a cypherpunk ideology that viewed government as an adversary, this was a moment of reckoning. The old mantra of move fast and break things had run headfirst into a brick wall of federal power. You couldn't just write better code to solve a subpoena. You couldn't fork the United States government. The crypto world realized it had to evolve. It had to learn to speak a new language, the language of power, of lobbying, of Washington, D.C. And so the rebels put on suits. A new class of crypto leaders emerged. They weren't anonymous coders hiding behind pseudonyms. They were polished executives, former regulators, and high-powered lawyers. Organizations like the Blockchain Association and Coin Center were formed, pooling resources to hire the best lobbyists money could buy. They began walking the halls of Congress, educating senators and representatives who just a year prior might have thought blockchain was a new type of children's toy. They started funding political campaigns, making donations to pro-crypto candidates on both sides of the aisle. The industry was fighting back, not with code, but with the tools of the very system it once sought to replace: money and political influence. It was a painful, expensive, and deeply ironic transformation. The anarchists were now playing the inside game. But while this political battle raged in the West, the specter of the CBDC continued to grow. China's digital yuan was no longer a theoretical project. It was being rolled out to millions of citizens. And other nations were taking notice. The European Central Bank announced plans for a digital euro. The Bank of England began exploring a brick coin. Over 100 countries, representing over 95% of global GDP, were now in some stage of exploring a CBDC. This was the ultimate dilemma, the central conflict that would define the next decade. A CBDC offers governments a dream come true: programmable money. Imagine a currency where your stimulus payment could be programmed to expire in 30 days to force you to spend it. Imagine money that could be blocked from being used to buy certain goods like sugary drinks or firearms. Imagine a world where every single transaction you ever make is logged on a central government ledger, potentially linked to a social credit system. It's the efficiency of digital currency combined with the surveillance power of a totalitarian state. This is the future that governments are quietly building. And it presented a stark choice for humanity. On one side, you have decentralized, permissionless, open-source protocols like Bitcoin, hard money that no single entity can control, inflate, or censor. It is freedom, but it is also volatile, messy, and unregulated. On the other side, you have centralized, permissioned, state-controlled CBDCs, stable, efficient, and deeply integrated into the existing system. It is control, but it is also convenient and safe. The battle was no longer just about technology or finance. It had become a global referendum on the future of money itself, a philosophical clash between centralization and decentralization, between freedom and control. The lines were being drawn not just between crypto and the state, but between two fundamentally different visions for the future of society. And as this epic struggle unfolded, a third colossal power, which had been watching silently from the sidelines, finally decided it was time to enter the arena. They weren't governments or cypherpunks. They were the titans of traditional finance, the kings of Wall Street. And their entry would change the rules of the game forever. For years, they had dismissed it as a sideshow, a fraud, a rat poison squared. A clever but ultimately useless creation of anonymous coders in the digital shadows. While the world debated the merits of decentralization and the future of money, the titans of traditional finance watched with a mixture of amusement and contempt. They were the house. They owned the casino. They didn't need to play the strange new game being invented in the corner. But the noise from that corner got louder. The jackpots grew bigger. And soon, their own high-rolling clients started walking over to that corner, asking how to place a bet. The first rule of being the house is you never let the money leave the building. The change wasn't a sudden epiphany. It was a slow, reluctant pivot, born not of belief, but of brutal, undeniable economics. It began with whispers in boardrooms, with the creation of blockchain research departments that were little more than corporate listening posts. It was JP Morgan's CEO, Jamie Dimon, famously calling Bitcoin a fraud on public television, while behind the scenes, his own bank was building the infrastructure to trade and custody these very assets for its largest clients. It was the classic Wall Street playbook. Publicly denounce an innovation to maintain the status quo, while privately preparing to dominate it if it becomes inevitable. And crypto was becoming inevitable. The problem for big money wasn't desire. It was plumbing. A pension fund managing billions of dollars couldn't just go on a crypto exchange and buy 100,000 Bitcoin. Where would they store it? Who would insure it? How would they comply with decades of financial regulations? They needed a bridge. A secure, regulated, and, most importantly, familiar way to connect the trillions of dollars in the old world with this explosive new asset class. They needed a product they understood, one they could sell to their clients with a straight face and a prospectus. They needed an exchange-traded fund, an ETF. For those unfamiliar, an ETF is a kind of magic trick of modern finance. It allows you to buy a stock on a regular stock exchange that represents ownership of something else like gold or a basket of the top 500 companies. You don't have to worry about storing gold bars in a vault or buying 500 individual stocks. You just buy one ticker symbol and the fund manager handles the rest. It's simplicity itself. And for Bitcoin, it was the holy grail. A spot Bitcoin ETF would mean anyone with a brokerage account, from a hedge fund manager in Manhattan to a retiree in Florida, could buy Bitcoin as easily as they could buy a share of Apple or Amazon. But the gatekeeper to this holy grail was the U.S. Securities and Exchange Commission, the SEC. And for nearly a decade, the answer was a resounding no. The Winklevoss twins of Facebook fame were the first to try way back in 2013. They were rejected. Many others followed. All rejected. The SEC's reasoning was always the same. The underlying Bitcoin market was too volatile, too unregulated, and too susceptible to fraud and manipulation. It was the Wild West and they refused to build a bridge to it. Year after year the cycle repeated. A company would file an application, the crypto world would get its hopes up, and the SEC would deliver the inevitable rejection. It seemed like an unbreakable stalemate. But then, one company decided to stop asking for permission and start fighting back. That company was Grayscale. Grayscale already had a product called the Grayscale Bitcoin Trust, or GBTC. It was a closed-end fund that allowed accredited investors to get exposure to Bitcoin, but it was clunky. It often traded at a significant discount or premium to the actual price of Bitcoin, and it wasn't nearly as accessible as an ETF. Grayscale wanted to convert their trust into a true spot ETF. And like everyone else, the SEC denied them. But instead of retreating, Grayscale did something audacious. They sued the SEC. They argued that the Commission's position was illogical and inconsistent. The SEC had already approved Bitcoin futures ETFs, products based on contracts that bet on the future price of Bitcoin. Grayscale's argument was simple. If you're comfortable with an ETF based on the Bitcoin futures market, how can you claim the underlying spot market is too manipulated to support an ETF? The two are intrinsically linked. It was a powerful logical argument. And to the shock of the financial world, in August of 2023, a federal court agreed. The judges ruled that the SEC's denial was arbitrary and capricious. Grayscale had won. The court's decision didn't automatically approve their ETF, but it blew a hole the size of a freight train in the SEC's wall of rejection. The legal foundation for denial had crumbled. The stalemate was broken. And that's when the shark entered the water. Just before the court's decision, the world's largest asset manager, BlackRock, a financial behemoth with over $10 trillion under management, had filed its own application for a spot Bitcoin ETF. This was the moment everything changed. BlackRock isn't just another company. They are the establishment. Their influence is immense, and their record of getting ETFs approved by the SEC was, at the time, 575 to 1. When BlackRock makes a move, it's not a speculative bet. It's a declaration that a new market is about to be born. Suddenly, the narrative shifted from if to when. The floodgates burst open. Fidelity, Invesco, ARK Invest, Franklin Templeton, every major player in the asset management world stampeded to get their own application in line. The race was on. Finally, on January 10, 2024, the inevitable happened. The SEC, cornered by the courts and pressured by the biggest names in finance, approved 11 spot Bitcoin ETFs simultaneously. For the first time in history, the bridge between traditional finance and the digital asset world was officially open for traffic. And the traffic was immense. In the first month alone, these new ETFs saw billions of dollars in net inflows. On some days, the demand was so high that the ETFs were buying up more than 10 times the amount of new Bitcoin being created by miners each day. It was one of the most successful ETF launches in history, validating everything the believers had been saying for years. The institutions had arrived. The capital was real. Bitcoin was no longer on the outside looking in. It was now a feature on the menu at the most exclusive financial restaurants in the world. But this grand arrival came with a deep philosophical cost, creating a fundamental schism in the very soul of the crypto movement. On one hand, this was the ultimate validation. Bitcoin, the asset designed to be an alternative to the traditional financial system, had now been officially embraced by it. Its legitimacy was cemented. Its potential reach expanded to every corner of the global economy. This was a victory for adoption, a pathway for Bitcoin to achieve its potential as a global store of value, a digital gold for the 21st century. On the other hand, it felt to many early adopters like a profound betrayal. Satoshi Nakamoto created Bitcoin to be a peer-to-peer electronic cash system, free from the control of banks and intermediaries. Now, those very same intermediaries were packaging it, charging fees for it, and selling it back to the masses through the same old centralized systems. They weren't adopting the ethos of decentralization. They were simply financializing a new asset. This wasn't a revolution. It was a corporate takeover. A wild, untamed frontier asset had been captured, domesticated, and put in a Wall Street zoo, where people could pay a fee to look at it safely from behind the glass. This is the great paradox of institutional adoption. To achieve mainstream success, did Bitcoin have to sacrifice its soul? By inviting the kings of the old world into its kingdom, did it ensure its long-term survival? Or did it merely surrender the throne? This wasn't just about price charts and capital flows anymore. It was a battle for the very identity of digital currency. And with Wall Street now firmly at the table, the rules of engagement were being rewritten in real time. The old battles were over. The fight for legitimacy was won. But a new, far more complex conflict was just beginning. A conflict that would determine not just the price of these assets, but their ultimate purpose in the world. This new conflict wasn't fought with marketing campaigns or regulatory lobbying. It was a philosophical war, a battle for the very soul of this new technology. On one side stood the fortress. On the other, the sprawling, chaotic metropolis. And the choice between them would define the next century. The fortress was the vision of Bitcoin and its most ardent believers. To them, the purpose of digital currency was singular, pure, and absolute. To create the world's most perfect store of value. A digital gold. An asset that could not be debased, could not be censored, and could not be controlled by any government or corporation on Earth. Its slowness wasn't a flaw, it was a feature. Its resistance to change wasn't a weakness. It was its greatest strength. Think of it like the bedrock of a continent. Doesn't need to be fast. It doesn't need to host applications or process a million coffee purchases a second. It just needs to be unshakably, predictably, and eternally there. In a world of financial chaos, of printing presses running hot and currencies collapsing, the fortress offered something that had become terrifyingly scarce: certainty. Every 10 minutes, a new block is added. The supply is capped at 21 million forever. The rules are transparent and almost impossible to change. This wasn't a system for building things on top of, it was a system for building things out of. It was the final settlement layer, the court of last resort for global value. The advocates of this vision weren't trying to build the future. They were trying to preserve it. They saw a global financial system built on a foundation of sand, and they were offering a foundation of granite. But across the digital chasm, a completely different vision was taking shape. This was the metropolis, the vision of Ethereum and the platforms that followed in its wake. If Bitcoin was a vault, Ethereum was a construction site. It was loud, messy, constantly evolving, and filled with a frenetic energy that was both exhilarating and terrifying. Its goal was not to be a static store of value, but a dynamic, programmable foundation for a new internet. A world computer. This vision saw the blockchain not as a finished product, but as a blank canvas. The value wasn't just in the currency itself, but in what you could build with it. Suddenly, code wasn't just for creating websites, it was for creating law. Smart contracts became the digital equivalent of legal agreements, executing automatically without the need for trusted intermediaries. This single innovation unlocked a Cambrian explosion of new ideas. Decentralized finance, or DeFi, emerged as the city's financial district. It was a parallel financial system being built in real time, with lending, borrowing, and trading happening 24/7, governed by code instead of by bankers. NFTs, or non-fungible tokens, became the city's art galleries and property registries, creating provable digital ownership for the first time in history. DAOs, or decentralized autonomous organizations, became its new experimental forms of governance, internet-native communities that could pool capital, make decisions, and manage projects collectively. This metropolis was a place of infinite possibility, but it was also a place of immense risk. It was a frontier town, complete with scams, failures, and spectacular collapses. While the fortress of Bitcoin prioritized security and decentralization above all else, the metropolis was locked in a desperate struggle to achieve something far more difficult: to be secure, decentralized, and scalable enough to serve billions of people. This is the famous blockchain trilemma. You can have any two, but achieving all three is the holy grail. The fortress chose security and decentralization, sacrificing scalability. The metropolis, in its quest to become a true world computer, had to chase scalability, often making compromises that introduced new risks and vulnerabilities. This technical trade-off was a direct reflection of their philosophical differences. Do you build an impenetrable bunker that can protect immense value but does little else? Or do you build a vibrant, global city that can host the next generation of the internet, but might have its infrastructure creak and groan under the strain? For years, this was the central conflict: the stoic, unchanging digital gold versus the dynamic, ever-evolving world computer. But as the ecosystem matured, a third path began to emerge, complicating the narrative. The world, it turned out, might not need just one fortress and one metropolis. It might need an entire civilization of specialized cities, towns, and outposts. This was the rise of the application-specific blockchain. These new networks weren't trying to be the ultimate store of value or the computer for everything. They were designed to do one thing and do it exceptionally well. Imagine a blockchain built exclusively for managing global supply chains, tracking goods from factory to consumer with perfect transparency, or a network designed specifically for the high-speed, low-cost transactions required for 1 billion people to play a video game, or another dedicated entirely to securing digital identity, giving you ultimate control over your own data. This multi-chain vision proposed that the future wasn't a winner-take-all competition between two superpowers. It was an interconnected ecosystem of sovereign digital nations, each with its own unique culture, economy, and purpose. A blockchain for finance would have different priorities and different rules than a blockchain for social media or for art. This idea was incredibly powerful because it mirrored the way the real world works. We don't have one giant country that does everything. We have a complex tapestry of nations that specialize in trade. But this vision created a new monumental challenge. If you have hundreds of different blockchains, how do they talk to each other? How do you move value from the fortress of Bitcoin to the metropolis of Ethereum to a specialized gaming network and back again? Without a way to communicate, these digital nations would be isolated islands, their potential forever limited. The answer was a new piece of technology: the cross-chain bridge. Bridges are the digital equivalent of shipping lanes and trade routes, designed to allow assets and information to flow seamlessly between different blockchain ecosystems. They are the critical infrastructure that could potentially unite this fragmented digital universe into a cohesive whole, an internet of blockchains. The development of these bridges represented a new frontier, a quantum leap in the potential of the entire space. It meant that the strengths of one chain could compensate for the weaknesses of another. You could use Bitcoin security to anchor your value, then use a bridge to move a representation of that value into the metropolis of Ethereum to use in its advanced financial applications, and then move the proceeds to a high-speed chain to buy a digital collectible. This was the dream. a fluid, interoperable web of value. But these bridges also became the ecosystem's single greatest point of vulnerability. They were complex, difficult to secure, and became prime targets for hackers. Securing a single fortress is one thing. Securing the thousands of trade routes that connect an entire civilization is another challenge entirely. The largest and most devastating hacks in the history of digital currencies have happened not on the core blockchains themselves, but on the bridges connecting them. And so the conflict shifted once more. The battle was no longer just about which philosophy was right, the fortress or the metropolis. It was about whether this collection of digital nations could solve the immense challenge of interoperability. Could they build secure bridges and create a truly global interconnected network? Or would the inherent tribalism and technical risk cause them to splinter into isolated, warring factions, each walled off from the others? The fate of a truly open, global and decentralized future hung precariously in the balance, resting on these fragile digital links between worlds. This tension, this risk of a digital balkanization, is not a bug in the system. It is the central question the system was designed to answer. The entire promise of this technology isn't just to create a better kind of money, but to forge a different kind of connection. For decades, the internet has been the great connector of information, but it has lacked a native way to connect and transfer value, ownership, and trust without a middleman. Every time you've sent money, signed a contract, or even just logged into a service, you've been forced to go through a central gatekeeper, a bank, a lawyer, a tech giant. These gatekeepers provided a crucial service, but they also became single points of failure, control, and censorship. What we are witnessing is the painstaking, chaotic, and often frustrating construction of that missing layer for the internet. A value layer, a trust layer, a layer where ownership is not granted by a corporation, but is a mathematical fact, verifiable by anyone, anywhere. The long-term potential of digital currencies is not about which token goes to the moon. It's about whether humanity can successfully build and adopt a global, neutral, and open infrastructure for value. Think of it less as a new asset class and more as a new institutional technology. For centuries, our most important institutions, governments, legal systems, corporations, have been built on a model of top-down hierarchical trust. We trust the bank because it's regulated by the government. We trust the government because we trust its legal foundations. But this model is showing its age. It's slow, expensive, and increasingly fragile in a globally connected world. Decentralized networks propose a radical alternative: institutional technology built on a model of bottom-up, mathematical trust. You don't need to trust a person or a board of directors. You only need to trust the code and the mathematics, which are open for all to see and inspect. This is a monumental shift in how we organize human cooperation. It's a move from trusting people to trusting protocols. And this new foundation enables far more than just digital cash. It allows for the creation of what some call a sovereignty stack for the individual. At the bottom layer, you have financial sovereignty. For the first time, a person can hold their own wealth in a way that cannot be unilaterally frozen, seized, or debased by a third party. This is a profound check on power, with implications we are only beginning to understand. Above that, you have the potential for data sovereignty. In the current web, our identities, our social graphs, our entire digital lives are owned by a handful of companies. We are the product. A world built on decentralized identity standards would allow you to own and control your own data, granting access to services on your own terms without sacrificing your privacy or ownership. Your online identity would finally belong to you. And at the top of that stack, you have what you could call organizational sovereignty. Through structures like decentralized autonomous organizations, or DAOs, we are seeing the first primitive experiments in building internet-native organizations. These are groups of people from around the world, coordinating and governing themselves according to rules encoded in smart contracts. They are testing new models of governance, of treasury management, of collective decision-making, all on a global and transparent scale. It's messy, but it's a laboratory for the future of work and community. This is why comparing this moment to the dot-com bubble, while tempting, is ultimately a category error. The dot-com bubble was about building new businesses on top of the existing internet infrastructure. This is about building a new infrastructure altogether. A more fitting analogy might be the printing press. Before Gutenberg, information was controlled by a select few. The printing press decentralized the creation and distribution of knowledge, unleashing centuries of progress, turmoil, and reformation. It fundamentally rewired society. Or consider the standardization of railroad gauges in the 19th century. A seemingly boring technical detail that, once solved, unlock the potential for a truly national interconnected economy. Digital currencies and the blockchains they run on are a potential standardization for value and trust in the 21st century. Of course, the path forward is littered with dragons. The legitimate criticisms are deafening for a reason. The space is rife with speculation, scams, and outright fraud. The user experience is often abysmal, a cryptic maze of wallet addresses and gas fees. The environmental concerns, particularly around proof of work, are serious and demand innovative solutions. And the regulatory uncertainty creates a chilling effect on builders and users alike. But these are not reasons to dismiss the entire endeavor. They are the problems that a generation of engineers, entrepreneurs, and thinkers are now dedicated to solving. The early days of the internet were also a chaotic wilderness. It was slow, unreliable, and filled with get-rich-quick schemes. It took decades of building, of creating protocols like TCP/IP, browsers like Mosaic, and companies like Amazon, to tame that wilderness into the indispensable utility it is today. We are in the early, messy dial-up modem phase of this new web. The ultimate question is not about technology. It's about what kind of digital world we want to live in for the next century. Do we want a world where our financial lives and digital identities are held by a few centralized custodians, subject to their rules, their failures, and their whims? Or do we want a world built on open, neutral protocols, where we have genuine ownership and control over our digital selves? A world where the networks we use are not just services we rent, but platforms we can co-own. This is the true long-term potential. It's the chance to re-architect the economic and social plumbing of the internet, baking in principles of ownership, transparency, and individual empowerment from the ground up. It's the potential to create financial systems that are more accessible to the unbanked, to build social networks that are resistant to censorship, and to enable global communities to coordinate and fund projects that were previously impossible. This future is not guaranteed. It is not a passive destiny we are drifting towards. It will be built choice by choice, line of code by line of code. The optimistic vision of an open, decentralized world could easily be co-opted, turning into a dystopia of perfect surveillance and control under the guise of central bank digital currencies. The technology itself is neutral. It is the values we embed in it that will shape our future. And so the journey doesn't end here with this video. This is where it begins for you. The most important investment you can make is not in any single coin or token. It is an investment in your own understanding. Read, learn, and question everything. Engage with the arguments from both the fiercest critics and the most ardent believers. Try to understand the underlying principles of self-custody, of consensus mechanisms, of smart contracts. Because this isn't just a financial revolution or a technological one. It is a cultural one. It asks us to reconsider our relationship with trust, with value, and with power. The story of digital currencies, in the end, is the story of a global open-source effort to build a more equitable and resilient foundation for human interaction. It is an audacious, improbable, and deeply human endeavor. The future is not yet written, but for the first time in history, the tools to write it are in the hands of the many, not the few. And that may be the most valuable potential of all.